Well, I didn't expect the secret to get out so quickly, but Mike is right. It's been a rough ride and I'm starting something new on the side, and I really hope you're all supportive of me on this new venture. Look, I'm just kidding, let's get serious. Well, that's better. So look, long before I ever invested into HITide or shared any videos on this channel about the company, as something I do with every investment I make is to try and understand for myself what the true potential of the company is over the coming years. Clearly, over the life of an investment, this can change, both positively and negatively, and good investors should keep an eye on this and follow it continually and understand what the upside potential looks like, as clearly this is something which is relevant for exit timing too. Now, in the case of HITide, there have been two recent-ish developments which, setting aside the potential debate for federal legalisation, present HITide with a very tangible opportunity to be hitting $100 million of EBITDA by 2023. Now yes, I know you probably think I'm crazy throwing this out there, and clearly this is an upside bull case theory, and yes, I know it is nearly double what the analysts are currently forecasting for 2023, but in this video I'll run you through my analysis for this point. Now when I say this too, this is clearly reliant upon perfect execution, some luck, and as with everything, some timing fortune too. Now don't hold me to these numbers, but what I will do is share with you my analysis on the potential here with just the existing building blocks of the business as it is today. No new M&A, no crazy new product development, just what the business is today. Also, just to set the scene, I'm referring to 2023 as in the October year ending October 2023, or 2 years from the most recently filed results. Analysts for this period are forecasting 45.5 million of EBITDA being generated off around $526 million of revenue. Now, as we've seen historically, HITide has a good track record of beating this. Now, before we get into it, and given the nature of this video, I just want to make it very clear that while I work in a full-time investing related job, I'm not a financial advisor, and this video is purely for entertainment and educational purposes only. And while you're here, hit the like button, subscribe if you aren't already, and check out the Patreon group for the private Discord and a load of other things. But with that said, let's get straight into it. So, how is HITide going to do this then, and why is nobody yet talking about this? Well, I think they are actually talking about it, but analysts are typically pretty conservative and don't bake much of this into their forecasts. Now, the first of these steps, I believe, is the membership program. Now, we know from the Q4 results that there's been enormous growth in this part of the business. At the current growth rate, it would not be crazy at all to assume that this membership program would be at 1 million members by the end of next year. Now, for those not familiar with what being a member offers, it basically gives you an enormous discount on buying items, just for being a member. Yes, currently membership is free, however there's clearly a great strategic play here. If HITide was to include a membership fee of say $50, they could clearly monetize this membership program. A fee of $50 would easily be compensated in one single transaction due to the magnitude of discounts being offered. The question's almost, do you want to buy the vape which you've come into the store to buy anyway for $150? Or instead, do you want to pay $50 to join the membership program, secure a year of discounts, offers and promotions, and then buy the same vape that you were going to buy for $150 instead for $75? Now the interesting thing is that HITide can do this while its competitors will struggle to. And this is because of its business model and the ownership of the accessories category that it has. And as a one-stop shop solution, this becomes even more powerful. The discount itself also becomes valuable even if you only buy cannabis products over the course of a year too. So it really is a no-brainer, even if somebody takes it down to that mathematical level. Now, I'm also not saying scrap the free tier entirely either. Instead, I'm supportive of keeping this because the data it collects is powerful and useful, but instead reducing the discount these members get to say only 10% or so. This would then still provide the incentive to give an email which is useful for marketing and insight, but still then enough of an incentive to join the paid tier and get further discounts. Now financially, and how this impacts the P&L, is that $1 of revenue from the membership program has no direct cost associated with it, nor any indirect cost. So this flows down the P&L or the income statement, depending if you're fussy between GAAP or IFRS, all the way down to EBITDA and ultimately net income. Now let's assume conservatively that 50% of those million members take up the paid option of membership. Now personally, I do think that's a touch conservative, as there are clear economic benefits to taking the paid membership, but let's say 50% of that 1 million members take the $50 membership. That's 500,000 customers each paying $50, which equates to $25 million in additional revenue, and therefore $25 million in additional EBITDA. Now take this $25 million of additional EBITDA and add it to the analyst estimates of $45.5 million, and you get a new EBITDA of $70.5 million. Now yes, there are challenges to this, and maybe the 50% is too high, maybe the $50 is too high, but I've used simple figures indicatively here. I do believe there's validity in them, but I'm not saying that these are set in stone, and they're just my ideas and clearly open to challenge somewhat. But the most important point here is about the potential magnitude that every dollar of that membership revenue could have on EBITDA. Now the second piece of this puzzle, for me, is the B2B tech potential within the business, or said differently, the potential from licensing the technology capabilities within HITide, which it acquired in the Fast Tender acquisition, and selling this and licensing it to other players in the cannabis sector. Now we can do this by looking at Fire and Flower, one of HITide's main competitors. For the Q3 year-to-date 2021 period, their most recently filed accounts, staff costs were $23.9 million, or 53% of the SG&A expenses, or 20% of sales. Now, assuming that the Fast Tender technology again can increase staff efficiency by 1/3, or said differently, the company only needs 2 staff per store rather than when they may have had 3, due to leveraging the technology, this could have an enormous benefit for the cost base and for Fire and Flower. Now let's follow through that example to demonstrate the point. Reducing the cost base by 1/3 would decrease staff costs by $7.9 million to $15.9 million, effectively improving the EBITDA margin by nearly 7%. Now let's say that HITide was to license this software to Fire and Flower for $2 million per year. Now clearly that makes a very compelling argument for Fire and Flower, and arguably you would see this cost saving split 50-50 more, if not more in favour for HITide. However, we're being conservative here. As with the membership revenues, these have no cost associated with them and flow straight down to EBITDA. So then assume that HITide is able to achieve $25 million in sales from this software being licensed out to the entire market, and that's not just from the Canadian market, there's also potential in the US and other markets too. The opportunity here is enormous. So add that $25 million from the software sales to the $70.5 million we had before, and that takes you to an EBITDA of $95.5 million. Now, what this also is excluding from the calculation is the enormous benefits which that technology will bring within HITide, which then easily take you back to that $100 million of EBITDA mark that we discussed. Now, very quickly, to ask the question that's probably on everyone's lips is, why would Fire and Flower license this from another player? Why would they license it from their largest competitor? Well, ultimately, I'm sure they're going to try to copy and create their own solution. However, they'll end up spending way more than they would in trying to develop this and getting it to a point that it works than they would if they were just to license it through HITide. So ultimately, I think the licensing solution makes way more sense. There's less risk around it, it's already a working product, it's cheaper, and they're not spending the capex or the investment into the product. And ultimately, it's just the less risky move for them. So anyway, at $100 million of EBITDA, what does this mean for HITide's valuation? Well, there are a couple of important components and considerations here. Firstly, a business with subscription sales and tech sales of $50 million, as it would do if it was to deliver on both of those business lines which we discussed, would result in a meaningful re-rating. Even if the market only looks at it on the basis of that part of the business for it to be valued in line with other companies, one could even think about this on a revenue multiple basis rather than an EBITDA one. Now next up, with that level of scale, the company would be a market leader by a long way, which would further support a meaningful re-rating to a much higher EBITDA multiple. Now, even on the basis of the current valuation, HITide is trading at around 7 times its FY23 EBITDA forecast at $45.5 million. Now, this is clearly ludicrously low, but that's a topic for another video entirely. If HITide was to maintain this ludicrously low valuation multiple and deliver the $100 million of EBITDA that we've outlined, this would result in an enterprise value of $700 million, or just over double its current enterprise value. Now personally, I do think there is significant re-rating potential, and there's no reason that the valuation multiple should not be 2 or 3 times that multiple down the line, which clearly has further significant implications for the value of the company. So in summary, I'm not saying this is set in stone or that I definitely think this will happen. I think the company will commence on a strategy focused more around growing these 2 business lines which we've mentioned, but they may hit bumps in the road and there's clearly some execution risks to this too. Now it won't happen perfectly, but this solution I've outlined here would be an ideal best case solution. Now on top of this, also factor in that Raj is very likely to be looking at more technology businesses as well, which will then further add to that overall profile of the business. Anyway, that's it for this video. I hope you enjoyed it. If you did, please smash the like button. If you're new to the channel, then make sure you're subscribed and check out the Patreon for the private Discord group. As always, please let me know your thoughts and comments in the comment section below. I love hearing all the different opinions and perspectives, so please get involved. Thanks again for watching, and I'll see you in another video.